West Virginia became a combined reporting state in 2009. 2009. Actually, the legislation was passed in 2007, and that was one of the reasons why the business franchise tax was eliminated, because for the most part, combined reporting states do not have secondary franchise taxes, but the separate accounting states, many of them, not all, but many of them have secondary franchise taxes. The West Virginia tax in fiscal year 15, it yielded more than $190 million. Similar to the personal income tax, we do not reinvent the wheel. In fact, most states same way, makes it easier on the tax practitioners to be able to go from a federal return right over to a state return. So we tie very heavily in the federal code. In the case of the corporate income tax, the definition is federal taxable income. 46 states and DC use some definition of federal taxable income. It may vary a little bit from state to state. Not all states are up to date on their definition of federal taxable income. West Virginia is. West Virginia runs an update bill for both personal income tax and corporate income tax every single year, and we are tied to the current federal tax code. Some other states may not be tied to the current federal tax code. I'm not sure the current status, but in many years the state of Kentucky deviates from the federal tax code by tying into an older version rather than a newer version. So not all states are the same that way. It's easier for businesses if we tie into the current code. There are six states with no corporate income tax: Nevada, Ohio, South Dakota, Texas, Washington, and Wyoming. Ohio and Washington impose gross receipts taxes on their businesses, and that's in lieu of the income tax. Nevada imposes an employer wage tax and is currently trying to implement an additional gross receipts tax. Of course, West Virginia, prior to 1987, we were a gross receipts tax, not so much an income tax state. South Dakota imposes an income tax, but it's only on financial institutions, so it's very limited. And Texas imposes a gross margins tax. State of Wyoming is a major severance tax state, lots of minerals, very few people, and they rely very heavily on the severance tax as well as property tax and sales tax. Just as with the personal income tax, there are increasing adjustments and decreasing adjustments on corporate income tax. Very similar. Interest income and dividends from any state and local bonds are added back for West Virginia, and I'll get to a little difference between on the corporate side versus the personal side in this regard. And then U.S. obligation interest or dividends net of expenses that are not exempt from state income tax. So any type of obligation that the state can tax, it's added back in. State and local income tax is deducted on the federal return, as well as foreign taxes. That's very similar to on the personal income tax side. It's an accounting adjustment. And the West Virginia corporate tax is a water's edge tax. It is, we will not include any foreign source income in the tax base. So any foreign taxes get added back. Federal depreciation on qualifying West Virginia water air pollution control facilities. West Virginia has a unique statute in that if you have water and pollution control facilities that are mandated, fit under certain definitions such as scrubbers and electric power plants, you can fully write off the expense in the year they occur as opposed to having to depreciate it over time. So this adds back to the federal depreciation because we're basically given the full cost accounting up front. Federal net operating loss deductions and net operating losses from sources outside the U.S. West Virginia provides an allocated state net operating loss as opposed to tying into the federal net operating loss. And then production income under Section Internal Revenue Code 199. Again, that's one of the few modifications that's in federal code that the state does not tie into. The state also requires corporations to add back their charitable contribution to the extent that they're claiming the neighborhood investment tax credit, because you get a tax credit for the contribution instead of a deduction. And then more recently, expenses related to certain real estate investment trusts and regulated investment companies and certain intangibles, and that was sort of added to the code prior to the state becoming a combined reporting state, but it's still in the code nonetheless. On the decrease and modification side, West Virginia state income tax refunds that are included in federal taxable income. Again, that's an accounting adjustment. Any types of foreign type income, foreign dividend, gross up, subpart F income, and taxable income from sources outside the U.S. because it's a water's edge tax. We do not tax foreign source income. Federal government does, but we do not. The cost of West Virginia water and air pollution control facilities, if not otherwise allocated, that is when we expense those facilities as opposed to depreciate those. So this comes out. Salary expense not allowed on the federal return due to the federal jobs credit. Basically, the feds don't allow the salary expense. We allow the salary expense because we do not tie into the federal jobs credit. Employer contributions to a West Virginia medical savings account not deductible on the federal return. Again, this is a modification that's been around for probably 25 years, and I'm not aware that there is such an animal out there. There might be somebody would disagree with me on that, but I'm not aware there is one. But we have it in code. And then we have a unique adjustment regarding tax-exempt obligations, such as U.S. obligations, West Virginia obligations, and we add in residential property tax mortgage obligations. Basically, instead of allowing a write-off of the interest income directly, we have an allowance that's equal to the share of total assets of your corporation that's attributable to these obligations. Total assets multiplied by your adjusted taxable income becomes a deduction. So that's a little different than the straight out interest deduction. And the reason why that has done is because if you have an income tax that's a franchise tax, you can tax U.S. obligation interest. If you have purely an income tax, you cannot tax U.S. obligation interest. And if you're in the banking industry, typically, oftentimes the state corporate income tax would yield no revenue at all from financial organizations due to the write-off of tax-exempt obligations, unless the state imposed it as a franchise tax, which might never matter, but as opposed to an income tax. So that's something that's been in code for a long time. Of course, most corporations, not all, but most corporations are multi-state in nature. They have income from all kinds of different sources. So that requires an allocation and apportionment to determine the portion that's subject to tax in West Virginia. Multi-state firms apportion their taxable income, determine the share to be in West Virginia, and it's a double-weighted sales formula. That is, it's West Virginia sales divided by sales everywhere else. 25% weight on property, West Virginia property versus property everywhere else, and 25% weight on payroll. There's a special formula for financial organizations. It's a single factor based on sourced gross receipts. There's, in addition to the apportioning of income, we also allocate certain types of income, particularly non-business income. It's typically allocated to a source state. These would be things like rents, royalties, capital gains, interest, dividends. In some cases, if it's wholly a West Virginia facility, a cost of pollution control facilities, and gain on sale of natural resources. Those would be all allocated to the state where they occur. If it occurs outside West Virginia, it's not allocated to West Virginia. If it occurs inside West Virginia, it's allocated to West Virginia. And then we also have was essentially an allocated West Virginia net operating loss. If the business activity in West Virginia results in a net operating loss deduction, then it's allocated to the state of West Virginia. This is a hypothetical tax calculation for a single multi-state corporation, ABC. They have $10 million in federal taxable income, $500,000 in increase in modifications, $800,000 in decrease in modifications. They also have $50,000 in allocated income. All that allocated income is outside of West Virginia. The apportionment factor, based on their portions of property, sales, and payroll, comes out to 1.334% for property. Did I have that backwards? I might have that. I have that backwards. That should be sales factor is 1.334. I must have been working late on Friday and didn't have my coffee or something or tea. But that's really the sales factor is supposed to be 1.334, and it's weighted twice. And then we'll just switch that around, and then the property would be 6.25%, and the payroll would be 9%, and divide that by 4, comes out to about 4.5%, and that's multiplied against the adjusted taxable income. Adjusted taxable income is $9,650,000 multiplied by the apportionment factor gives us $432,000 in income. That's apportioned zero in income that's allocated, total of $432,243. multiplied by our tax rate gives you a pre-credit tax liability of $28,096. So corporate tax is a little more complicated than most personal income tax returns. In terms of corporate tax rates, these are tax rates across the country. And in West Virginia, we're in the middle of the pack. Our tax rate's 6.5%. We're a green state. The states in red are the high tax states: Minnesota, Iowa, Pennsylvania, New Jersey, and Alaska fit into that group. There's also a number of gold states, including Maryland. It's our neighbor. And then there's some states that have lower rates than West Virginia, including a number to the southeast, particularly Kentucky and Virginia and North Carolina. I will note that a number of the states that are in blue have secondary franchise taxes. That includes the state of North Carolina, still has a business franchise tax as well as an income tax. Kentucky has some minimum tax provisions that apply to particularly to unincorporated entities. West Virginia does not have a tax on unincorporated entities. It basically flows through to the partners, but there are a number of states that actually impose an entity-based tax on the unincorporated entities, including places like Kentucky and in New Hampshire. This is where Mark Morton's going to take over, so I get a little rest. But basically, the question is, does your state require mandatory combined reporting? And if you're a red state, it does. If you're a blue state, it does not. Most of the red states are out west of the Mississippi. But in recent years, a number of states east of the Mississippi have gone to combined reporting, including District of Columbia, New York, West Virginia, and a couple of New England states. So now more than half of the states are combined reporting states. States that are combined reporting states, for the most part, there's a couple exceptions, do not have secondary franchise taxes. States that are separate accounting states, a number of them, not all, but a number of them have secondary business franchise taxes. And Mark, you get to tell us what combined reporting is all about, if your button's on.
You want any questions for him? All right. It's dead. Aha. All right, thank you. Combined reporting basically has been adopted by a great many states, and it's based on just a few sort of basic ideas. Members of a unitary group determine their income based on their activities as a whole. And a unitary group is essentially one where the activities of that group of corporations all contribute to the business enterprise. Instead of having one corporation doing everything, they break it up into smaller units, each of which is a separate related entity typically, and you end up in a situation where you're still doing one business, but you're doing one business with a multiplicity of corporations. And the way you get around the potential for sheltering income is to just determine the income based on the activity of that group as a whole. And you take the total group income as the income for West Virginia, and then you apportion it based upon, hold on, I have no idea what button to push here. That one, all right. Sorry about that. And you apportion it to West Virginia based on that unitary operation. So the taxpayer will typically file a separate return along with a combined report, and that combined report is where you add up all that multi-corporation income for the unitary group, and then you apportion it to West Virginia based on the numerator and denominator that are representative of, respectively, the West Virginia activities and the unitary group's activities. Here's the big long definition that we put in the code that we adopted from the Multi-State Tax Commission's Model Act. And basically, it says in a lot of fairly complex words that what we're looking at is a single economic enterprise. It just happens to be assembled in a way where there are a multiplicity of corporations or other entities doing that business, that economic enterprise. Whoops, sorry. This is fairly abstruse, but this just talks about the nexus presumptions that work with relation to West Virginia. If a member of a unitary group has nexus with West Virginia, then they're included in the sales factor numerator. If they don't, then they don't. There is another court case out that's based on a court case called the Joyce case. There's another one out there called the Finnegan case, where if you're a member of a unitary group and any part of that unitary group is doing business in your state, then the whole darn group becomes taxable in your state, regardless of the nexus of the individual entities. We don't do that, and my thought is one of these days Finnegan may very well be overturned because it looks to me like it's just overreaching. We have a throw-out rule in West Virginia that's a little bit controversial. There's basically, I think, only one state left that does that beside us. I believe it's New Jersey, and they're getting rid of theirs. And this is just a presumption about where a sale goes when it's not taxable in some other state. A great number of states throw them back into the state where the corporation has its nexus. West Virginia doesn't throw it back. It simply eliminates it from both the numerator and the denominator of the sales factor. That has been embraced, in certain economists and so on have talked about the idea that the throw-out rule is probably the best fit in terms of understanding the picture of what's going on economically. You simply eliminate the sale altogether as if it didn't exist at all. Whereas in the in the throwback rule, you actually throw it back to the state, put it in the numerator, and you tax it, even though arguably that sale doesn't necessarily belong to the state. This is one that Mr. Muco pulled together, so I'll let him talk about the conformity a little bit.
There's several features of the West Virginia Code that actually advantage businesses that operate in West Virginia versus elsewhere. And one of those is federal bonus depreciation, which started at the federal level back in 2002 as a temporary provision, and it has been extended for several years. It's now still currently in place at 50% level. West Virginia, since the beginning, has consistently conformed with the federal provisions for bonus depreciation. Most states in the country have not consistently conformed with federal bonus depreciation, and what happens is that causes more work for the practitioners, because that means you have to have separate depreciation schedules for your state that are separate from the federal. Whereas if you consistently conform with the federal provisions for depreciation, then you just carry over the federal income to the state and you apply tax to it. But this forces you to a number of different adjustments at the state level, and every one of those blue states has different rules. They're not consistent. Not only did they not tie into federal bonus depreciation, they offer different alternative rules, not necessarily consistent. So that means if you're a business, you have to file special depreciation schedules in a number of different states, which is probably a little bit costly and disadvantageous. West Virginia and Delaware are the only two states in the eastern United States, if Louisiana is in the eastern United States, that have consistently tied to federal bonus depreciation, which is helpful for state purposes. And what federal bonus depreciation does is it accelerates your depreciation. Right now, you basically expense 50% of your new capital investment, and you depreciate the other 50%. So it helps speed up that depreciation process, which is helpful for business. Another area of business, small businesses have the advantage of business expensing rules under Section 179, where you can expense up to $500,000 as a small business immediately. West Virginia, again, is one of the red states that consistently has conformed to federal small business expensing rules. There are a number of states in blue, such as our neighbor states of Kentucky and Maryland, that do not follow the small business expensing rules, and small businesses have less expensing leeway in those states than they do in a state like West Virginia. So that's important for the smaller businesses to be able to tie into the federal code and to more fully be able to expense capital investment. And one area that West Virginia does not conform to is Section 199. About half the states conform, the other half do not. We're a blue state here. Section 199 allows certain types of businesses, not all businesses, but certain types of businesses to deduct basically 9% of certain income that they earned related to production at the federal level. This was a provision put in the federal code to replace an earlier provision that was a tax credit that was running afoul of certain international trade conformity guidelines. The feds put in a special 9%. The deduction was a little bit vague, at least when it was first put in place, and the thought in West Virginia was rather than have the deduction, it'd be better to have lower overall tax rates. So to the extent that that deduction is not in the code, that allows a lower tax rate than would be if it were in the code. And with that, I'll open up to any questions.